Hey guys, welcome back to the After Hours. I'm the Aail Beast, and today we're going to talk about the return of the edge. The reason we say this is the return of the edge is because the situation we're in now is that we are in a bull market. And with this bull market, there comes bull market opportunities. We're talking about there's so much volume. You don't know what to do with it. And it's not in a specific sector like before. You've seen the return of AI. You've seen technology, and that's mostly to do with Nvidia. But what can we do with that? That's where you look at the Sympathy plays. If you see there's a main play going wild and it's creating new babies, you go after the babies. You don't go after it the first day. You go after it when it's safe. When we talk about trading, we want to make things as obvious and as simple as possible because we're going to be doing it for a while. And the more data we have, the more confidence we're going to have. Now, with that, we also want to talk about traps. We're talking about short traps and bull traps. When we talk about a short trap, you have to understand that we are talking about baits. We're talking about an easy opportunity. An opportunity that looks a little too easy. We're talking about easy to borrow. Overextension. The volume's extremely crowded. Everyone has the same idea. There's a high chance that you are a part of the 90%. Because remember, 90% of the people go long inside of the stock market, but only 10% of the people in the stock market are profitable. Okay, let's talk about bull traps and short traps. Let's say there was a resistance. With this resistance, there was a gap up, and then there was a pullback inside of the pre-market. Before the market opened, there was a long way before we got to that resistance. Most people would actually short right at the open. And because of that, it creates a morning dip. With that morning dip, we have to understand that buyers are going to come save the falling knife. And some short sellers that don't know better, they're going to chase that. And because of that, there's going to be an easy opportunity. The easy opportunity is the short squeeze. If you're trying to short that morning dip and there's a large gap between the resistance as well as your pre-market high from your current price, there is more incentive from the buyer side to reclaim those key levels. We're talking about you have to get past the pre-market high as well as you have to get closer to the resistance. If a person shorted right in the open or even tried to chase at the open, all the risk is on the short seller because each of the buyers are going to want to aim for each of those overhead resistances. They want to go back to the open. They want to go back to the pre-market high. And they want to test the resistance. They don't want to leave by themselves. They want to be kicked out. We're talking about every buyer wants multiple tests of resistance. Have you heard of the diamond hands? That's because they're always hitting the resistance and their hands are getting tougher. Now, the way you could tell it's a short trap is when the opportunity is just bad risk reward. We're talking about when the stock just does not want to die. There's usually a sign of higher lows. If you use VWAP, it reclaims the VWAP levels. If there is a potential squeeze, would momentum come into the stock? The last one will be a large consolidation. Let's say you know everyone is shorting this stock, but the stock refuses to break down. There's a higher chance that there's going to be a short squeeze. Let's go back to simple strategies. We already talked about how there's many types of price action. There's gap ups, there's parabolics, there's slow grinds. But what all of those have in common is the basics. We're talking about resistance as well as support. With those, you can make a decent risk-reward strategy based off your technicals. You might be willing to risk like a 1 to 4 or a 1 to 2. Now with that, you can make a long-term strategy where you can become profitable based off of your winning percentage with that thesis. This is why we consider the pattern king. And because of that, you need to stay disciplined to that pattern or it's going to mess up the plan. Now, when we look at all these charts, especially the ones with big volume, we have to understand that there is a continuation. We might be looking at a stock uptrend for 5 or 6 days. One of those days is going to need a breather. And that breather is going to be to go all the way back up, even more than it did the first time, or it's going to be the start of the next avalanche. Overall, we are in a crazy bull market. No one really knows what's going on. But what they do know is that retail traders are more emotional than ever. And because of that, when there is a cheap borrow, the crowd changes the edge inside of the stock. When there's enough people that see something obvious and they're in a desperate situation, they force the stock to work the way they want. And that's been happening a lot lately. A lot of the stocks, you'll see them die right out of the open because it's crowded. Or you'll see stocks open up with over 30 million volume, but then die really early. Overall, it's the return of the edge. We're talking about the edges that we only saw back in 2021. We see there's a lot of volume in the market right now. Now that volume is taking over all the edges inside of the market. We're not seeing the massive gainers that we saw in 2021, but we have seen the return of a lot of plays. We're talking about opportunities that normally wouldn't work out, but they are because we're in such a strong bull market. Now with this, you have to understand that if you draw the trend line properly, you will see the front side as well as the back side. Ever since this new bull market, new retail traders are coming back in, but it's also kind of a new market. everything has a positive sentiment. We're talking about those resistances that have huge amounts of back orders that normally would just die right at the open. Now they have a chance to come back within the hour. This happened over and over again in the past few weeks. Here's a few examples. RGLS. Normally, we don't trade biotech, but if there is enough volume on the biotech, this one had a pre-market volume of 24 million before the market opened. That's a lot of volume. That puts us at an estimate of 240 million by the end of the day. On that day, we ended up getting 167. So it was close, but not really that close. And that day was March 12th. Now on that day, this huge dip plus a push at the open, this allowed us to use it as a gap up short because it was gapped up enough for us to short this, which made it a morning edge only. But because there was so much volume involved and it's a biotech, there's a higher chance it's going to fill the gap. And it did. It filled that gap all the way to 380 before coming back down to $2. Let's talk about GXI. This one had a gap up from $5 all the way up to $11 before the market even opened. And it had a pullback. Now with these pullbacks, before the open, we see that as some type of resistance is being tested. And the more tests we see, the more we can validate that resistance. What valid resistance is, we call that decent risk management, because if we have a resistance to go off of, it's easier for us to put down a specific risk reward ratio. Now we're just all trying to be on the same side. In this case, when this opened, it was around 10 and then it pushed to about 12, maybe 13. That's right around the core resistance for this ticker. If you go back to last month, you'll see the consolidation for this resistance. It touched down around 9. If you go to the top of the consolidation, it's somewhere around 13. So if you find the middle for that, that's 12. So a lot of people just glancing over, they want to hit somewhere closer to 12. Well, if you're one of those people, you would have been one of the early shorts that got squeezed. So this went right past our plans we had at 12 and it went all the way to 16. Which is funny because we wanted this to stop at 12 or 13, but because the sentiment in the market is so strong, it went all the way to 16 before it actually tested a solid resistance, which is fine as long as you have the risk management and you see there is a qualified test of resistance and the volume is still picking up. You can use that as your edge.
Interested in trading like Steven Dux? It all starts with choosing the right broker. Dux Trading has partnered with Centerpoint Securities to supercharge your trading journey. By joining Centerpoint Securities through Dux Trading, you can unlock CP Edge, a suite of top-tier trading tools valued at over $6,000 right at your fingertips. Gain an edge in your trading with real-time scanners, cutting-edge news, and a personalized trading journal. Experience trading like never before, with superior short inventory, dedicated support, buttery smooth trade execution, and the opportunity to earn interest on any of your idle funds. Plus, enjoy competitive pricing that suits your trading style. Ready to elevate your trading? Simply click the link in the description below to get started. Now, let's dive back into the content.
Now, another ticker we had this week was RVSN. This one was a little tricky. This one had less than 5 million pre-market volume. And because of that, we expect less than 50 million volume on the overall day. We ended up getting 33 million volume, which is great because we were using this as a bounce short. Now with this bounce short, you'll see on the daily, we're using a resistance of 86 million on the daily chart. On this higher time frame, we can make opportunities on lower time frames. On that day, we gapped up into that resistance from 3 days ago. And you can kind of see when things are going to end up a little shorter than they should when it comes to these morning pushes. Because it only went to 420 and I just felt that it's going to come back down because it did a solid test, I only put in a third so I can add more on confirmation. I messed up on this. We had the correct thesis, but we had the bad technicals. Now let me show you a screenshot of what happened. Now I top ticked it with a third of my shares. When I did that, I chased into the panic. The panic or pullback was a lot stronger than I expected. It went all the way to 3. And then when there was a little bit of a bounce, I added another third. I wasn't supposed to add another third after that panic. I was supposed to add a third after confirmation. We're talking about there was supposed to be a reclaim of each of those key levels inside of that panic. And if you reclaim that level, that means momentum will come back into the chart. And there may be a chance that we come back to the high or even go past the high. Well, I want to wait till one of those levels fail. Instead, I just waited till any sort of strength came into the stock and then I went in. And then I did it a third time. That pretty much averaged down my trade all the way to 350. Now, if I kept my original position, the chances of me losing that trade were very little. but because I chased and then doubled down. The chances of me making money on that trade became a lot less. If anything, I got spooked out seconds before the actual drop. Now, the last one we want to talk about this week is APM. This one is just like the rest of them. It was a resistance play. We're talking about a bounce short. Again, normally we do not trade biotechs or microfloat. If we do, we trade them with very specific situations. And one of those situations is usually it involves a huge resistance or so much volume that you're just dealing with a lot of bad quarters. If we go back to the original incident, when this came down and it squeezed all the way up to 18, we understand someone's going to be bag holding in that situation. Well, when it came back up, we saw that there was a confirmed resistance around 10. And because of that, we saw the opportunity when this bounced again to 8, because we now have double layers of resistance. It went from 4 to 9. That's 100%. We like our gap ups, even if it's a microfloat. With the 100% extension and 70% squeeze from the opening on that day, we knew that this was going to be a great short. When we thought about this short that morning, we just saw this was up about 70%. Now, when this did a huge pullback in the pre-market, this set itself up as multi-layers of resistance. We're talking about at 9, at 10, and all the way up to 17. All we need was to have someone squeeze. We're talking about increase in volume. That's going to flip on itself later. The faster it goes up, the harder that resistance is going to activate. And we can use that as an edge. So here's a special lesson for you. Sometimes if there's enough people in the stock, there is a pattern break. We're not just talking about momentum and it flipping on its head. We're talking about when there's supposed to be a fresh chart because there's so many people. If there's enough people in a little amount of time, it's not sustainable, because we have to understand, for this stock to go all the way up and continue to go up, there has to be a constant influx of money. And without a constant intake of money, it's bound to drop. If we're looking at GXI and we see it had a recent reverse split, technically, most people find it really hard to risk manage, which means it's supposed to gap higher. And that's what happened. It gapped a little bit higher, but it's still activated. And then it came crashing down. Now, the reason it did that is because there were so many people involved. The sentiment in the market brought in new traders, and it woke up all the wallflowers. All those wallflowers got in the stock, and they saw the opportunity. All right, guys, that's all I got for you today. If you like what you saw, hit that like and subscribe button, and I'll see you in the next video. Peace.